Dear Vice President Schwarzenegger, dear colleagues, dear esteemed guests and friends, ladies and gentlemen, as Dean of the Faculty, it's my great pleasure to welcome you to the inaugural lecture of Professor Joachim Voth. I'd like to introduce him quickly to you. Joachim Voth was born in Germany. He did his undergrad studies in Freiburg and in Bonn. He studied economic history and philosophy. He then went on to the UK and did his doctoral studies and received a DPhil degree from Nuffield College, which is a college within the University of Oxford. He started his professorial career in Spain later on as an assistant professor at the Universitat Pompeu Fabra in Barcelona, and then became associate professor in climbing up the ladder academically, and also full professor until 2013, and right after that we were getting the pleasure to be able to hire him here for the University of Zurich engagement. He started as Professor of Development and Emerging Markets here in 2014, and very recently he was appointed UBS Professor of Macroeconomics and Financial Markets, which is the endowed chair of the UBS Center. Joachim Voth has received several honors and distinctions, and I'm only going to mention two of them out of the long list that I have in front of me. So the one thing I'd like to mention is he's a fellow of the Royal Historical Society, and he received what we call the Champions League in Research in Europe, the Advanced Investigator Grant from the ERC, the European Research Council, for asset returns in times of insecurity for a 5-year period. He's editor in many important and A journals of the field, Economic Journal as a joint managing editor. He's editor in Explorations in Economic History, associate editor in both the Quarterly Journal of Economics and the Journal of Economic Growth, and editor of the European Review of Economic History. So his work, and I'm getting more to some of the research challenges that he is investigating, he works on sovereign debt in historical perspective, asset market volatility, the origins and perspective and persistence of culture over the long run, political risk, and economic performance. I was looking into his long list of publications and just picked out the most recent current working papers that typically get me interested, learning what people actually do. And I'd like to highlight 3 of them rather quickly. One is his investigations into the German history, which is called Highway to Hitler. The second, Leverage and Beliefs, Personal Experience and Risk-Taking. And the third one, which matches very nicely to the description I just gave of his research area, is called Debt into Growth, which in particular tries to answer the question, why did the country that borrowed the most industrialized first? And this is the case of Britain, and I'm sure he can tell us much more in his inaugural lecture and his talk that he's going to give. Without further ado, I'd like to hand over the microphone to you, Joachim Voth. Please join me in welcoming him for his inaugural lecture.
Thank you so much for being here today. It's a pleasure and a privilege. Let me start off by motivating why we might be interested in drawing some policy lessons from history when we think about financial crises. So, as Professor Gall rightly pointed out, I'm not the youngest member of the profession. I've been around for a while, and I've taught financial crises for a number of years. And it used to be the case that when you did so, you had to motivate why this was important with a slide, for example, like this. This is American GDP between 1890 and 1940, and you can see it's bouncing around a trend of 0 between 1890 and 1929, and then something happens. That thing is the Great Depression. It's the biggest economic catastrophe in recorded history, and it's intimately associated with a AAA financial crisis. So, of course, nowadays it's much easier to motivate why you might care about financial crises because we've just been through one that in many dimensions was about to look just like the meltdown of the 1930s. So in case you haven't seen this, let me just show you how dramatic things were not even 10 years ago in a number of dimensions, and then also think whether perhaps there's something that we did with thinking about historical evidence that helped us avoid this meltdown. So have a look at what stock markets did in the 1920s, early 1930s, and in 2007, 2008. The red line here is the recent episode, April 2008, and the blue line is starts at June 1929. And as you can see, the initial decline in stock markets is actually much more rapid than anything that happens in the US. So the period that gave us the great crash of 1929 is actually a very minor traffic accident compared to the meltdown in global financial markets that we saw 8 years ago. Let's look at trade. The collapse of worldwide trade is one of the defining characteristics of the world economic crisis. And here you see exactly the same thing. In the 1920s, the decline initially is quite slow and it just carries on for a long time. The initial decline in the 2007-2008 crisis was every bit as big, if not an order of magnitude bigger, with trade volume declining by 20% within a few months of the crisis starting. If you look at output, the thing we should care most about, it doesn't look more dramatic, but the start looks every bit as dramatic as what we've just seen, so, as what we saw in the 1920s. So the decline from 100% to 85% is very, very similar to this industrial production, and then it turns around magically before hitting even 80%, whereas during the Great Depression we see a total output decline of almost 40%. So we seem to generate shocks that originate in part in the financial system that seem to be every bit as large as the ones we saw in the 1930s. We haven't lived through a financial crisis of exactly the same order of magnitude and gravity, and I'll circle back to why that actually was towards the end of this lecture. So it used to be the case that at least for developed countries we thought if we talk about the history of financial crises, or we talk about financial crises in general, we're always going to do this in black and white, meaning with pictures such as this one. This is a 1930s run on an American bank, and you can see, it looks definitely not like anything you'd see today. But then this happened. You have the run here on Northern Rock, and of course it's part of this continuous sequence of shocks hitting the financial system less than a decade ago. So what I want to do today is to share with you some of the thinking, some of it my own work, and more importantly other people's work, in thinking more about where these shocks come from, how they get transmitted to the economy, and in particular what we can do to reduce these shocks. And I'm going to take as a guiding, organizing principle of what I have to tell you the work by two very renowned economists who've written on exactly this, and with fortuitous timing came out with a book just after the financial crisis erupted, and that's the famous work by Reinhardt and Rogoff. So they have this masterful overview of 800 years of financial history called "This Time is Different." And their punchline is that people always think that this time is going to be different, and that's exactly the reason why it never is. Okay, so you have these cycles where everybody is cautious to start with, nothing goes wrong for a while, everybody becomes more confident over time that we've mastered the problem of financial instability and economic cycles, and risk-taking increases. It's like driving home from work and going around the corner just 1 kilometer faster every day. And that's fine for a week or two, but at some point, the laws of gravity will get you, okay? And then you get a financial crisis and the cycle repeats. So it's a very simple behavioral model where people actually have very low frequency feedback to what they do, and it goes periodically wrong, and about once a generation you end up with one of these gigantic crises, okay? And the implication, of course, is then that that's true, is that bubbles and crashes are basically a part of almost human nature, because we only learn so much in the course of a lifetime. There's very little that you can actually do about this. I'm going to try to convince you of a very different interpretation. I'm going to try to tell you that financial crises are like traffic accidents. We can never avoid them fully, probably, and they have a lot to do with the rules and regulations for driving on the road. And we can get rid of a lot of the instability, but this is going to come at a price. And some of the origins of this may well be behavioral, but the reasons why these things happen in the aggregate are not primarily behavioral, but regulatory. And that's good news in the sense that we can actually reduce the frequency, but in the same way in which we don't necessarily all want to wear a crash helmet crossing the street, even if that reduces the number of traffic deaths in a year, we may not actually want to reduce the number of financial crises to zero, okay? So I'm going to organize this in 5 steps. I've tried to think of something that could possibly be considered a little provocative. So let me give you what's on the menu. The first point is financial stability is easy, okay? And what I mean by that is we can actually make sure that nothing goes wrong in the financial sector. I'll try to spell out a little bit what that actually requires. Sovereign debt crises, even if you can't avoid them, don't need to hurt in terms of economic growth. There are actually ways to engineer that, and I'll give you some examples from my own research that point in this direction and also then illustrate what the implications in practical terms are to make that happen. The third point is even very high public debt doesn't have to be economically harmful. So I do not believe this article of faith in the Reinhardt and Rogoff view of the world that beyond 90% debt to GDP, terrible things start to happen and growth has to slow down. I think that's very misguided. We also have ways to avoid bubbles. Bubbles are probably the example of what people consider irrational behavior in financial markets. And I'm going to try to tell you that it's quite easy to avoid bubbles, but again, we have to think about the cost. And the implication of all of these things put together is that the optimal number of financial crises is not zero. We don't want to reduce traffic accidents to zero, and the same is true of financial crises. And I'm going to try to show you some evidence of the trade-off between stability and efficiency of growth and the absence of crises towards the end of this lecture. So let's start with the first piece of evidence. Stability is easy, okay? So here I'm going to show you the frequency of 3 different types of crises over time, going back to the 1880s, and the darkest part of the bars are the banking crises, the middle ones are the currency crises, and then the final bar are what we call twin crises, meaning crises where both currency crises and banking crises coincide. And as you can see, this varies over time. Some periods are more accident-prone than others. The interval period 1919 to 1939, for example, has a lot of all sorts of crises. The recent period is actually not looking that good in very long-term perspective. There is, however, this episode in the middle. There's the period 1945 to 1971. And the only type of crisis you get are currency crises. There are no banking crises for a quarter of a century. So as recently as the time when I was born, we actually lived in a world that basically had uninvented banking crises. And the question then is, why can't we do this again? So what happened? Where did this come from? And of course, it's partly driven by the experience of the 1930s. So as World War II is coming to an end and people consider how to construct a new financial system, there's the famous Bretton Woods Conference, and for example, Hayden White, Secretary of the Treasury, hails the agreement to found the IMF as a way to drive the usurious moneylenders from the temple of international finance. Okay, that's not quite the role that we think the IMF has today. And what he means is that the IMF is meant as a way to restrict cross-border capital flows. So that's the first thing that Keynes and White agree on, that yes, you can have trade, maybe you can have a bit of migration, but the one thing that we learned from the 30s is that we shall never again have massive cross-border flows of capital. So the stability, the miraculous stability of the post-1945 period is actually built on a complete absence of cross-border capital flows. Every financial market is basically domestic or nothing else. And there's an additional element to this. Keynes likes this idea because he feels that it makes it easier to manage domestic economies. So if you want a smooth economic cycle, then the idea that capital might actually flee is not what you want to take into account, and he also likes it from a social engineering perspective because it makes it easier to engineer what he called the euthanasia of the rentier class. So if you want to tax the rich who don't work, then this is definitely the way to go. So if you actually look at measures of capital account openness, literature to which I've contributed a little bit by coding up things like the annual IMF assessments of how open capital accounts are, every dot here is an observation. If you go back to the 19th century, everything is perfectly open. You can do whatever you want. As recently as 2000, this is an almost perfect measure too, and in between you have this huge U-shape with a trough in the immediate post-war period, where the biggest decline comes from the 1930s and as a consequence of the world financial crisis, and then you have this incredibly slow, gradual climb out of the trough, until by the 1970s, you're starting to see cross-border financial flows again on any significant scale. So, where does the stability miracle come from? Why do you see no banking crises, for example? So, banks are incredibly heavily regulated in the post-war period. They have to have pretty high equity cushions. You engineer an industrial structure that ensures that they basically have to make good money. Regulation Q in the United States, for example, bans the taking of interest on deposits. So the paying of interest on deposits. So if you deposit your money in the bank, the regulator says they cannot compete for your funds and pay you for it, and of course that's like a subsidy to the banking sector. Much of the lending is directed, it comes with political guidelines. There's a lot of government involvement in the banking sector, including equity stakes. And there's little competition from bond markets. So banks can basically monopolize the entire corporate lending business. Now, remarkably, in this period when capital account openness is very low and banks on the whole are very stable, growth is also very fast. This is the period in recent history that sees the fastest rate of expansion of output and the largest share of output growth being driven by TFP. So at a first pass, you can look at this and say, this is like the Goldilocks economy. There's nothing wrong, you get stability, but you don't seem to be trading off anything in terms of efficiency. Now, if you look more closely at where the productivity miracle comes from, it's pretty clear that there are some costs here. Much of the high rate of output expansion, for example, is clearly a result of a re-acceleration of the trend of allocating labor from agriculture to industry, which had stopped for half a century. So during the tumultuous first half of the 20th century, when you have two massive world wars and a world financial crisis, much of the decline in the agricultural share had come to a stop. In the post-war period, as you start to trade again, this re-accelerates. And the consensus when looking at post-1945 growth in Western Europe appears to be that that's a key driver of the speed of output expansion. And of course, just because growth was high doesn't mean that it could not have been higher. So if you actually look at, for example, the cost of financing, cost of capital, cost of equity, issuance, all of these seem systematically higher in the countries that do more of the capital control business. So with that, I want to move on and talk more about sovereign debt crises. And as you know, we've had a few recently. So there seems to be two narratives here too. One is the German-speaking world's preferred way of thinking about the Southern European debt crisis, and it all revolves around a slightly moralistic view of the world in which some people overborrow and then maliciously decide not to pay. And here the investor's willingness to actually hold some of these bonds at incredibly low yields, of course, is a sign of irrationality or of bailout hopes. And the right cure in this setting is either bail-ins, so you actually impose haircuts on the investors, or austerity, because people just need to pay up and spend less and live with higher taxation. So an alternative view of where financial and sovereign debt crises come from says, if defaults are anticipated, then the haircut in a sovereign default is like insurance, having to pay out. You, as a bondholder, get a pretty high return in good years, and when times are bad, you get less. You may get less of your money back, and you certainly don't get your interest. So you earn a good return in good times, and in bad times, you just share the pain. So in this setting, defaults are actually desirable because they're a way to sort of complete markets, and they may even be welfare enhancing. So I'm going to try to bring some empirical evidence here in. One, I think, an interesting stylized fact that's not particularly well known that speaks to exactly this question. And the second one, that's more of a sort of financial engineering perspective, if you will, on how to do sovereign debt better and to try to learn from the past. So the first thing, if you read many of these comments about how terrible sovereign debt has been, seems to be exaggerating the extent to which bondholders on average lose on a vast scale. If you actually do the long-term calculation, it looks something like this. For the last century and a half, investors in emerging market debts were promised something like 8.3% per year, nominal. They lost about 2.7 as a result of defaults, and inflation ate away another 3%. Then there's the benchmark yield that they could have earned on investing in British government bonds or in American treasuries, and that would have been about 2%. So compared to the alternative asset, they still have a real outperformance of about half a percentage point. So ex post, on average, not in every episode, not in every issuing country, but on average, bondholders did just fine. This is not a sign of irrationality. This is not the lemming-like stupidity that Reinhardt and Rogoff want us to believe in. This is people getting it right most of the time. And if anything, the rate of return is a little bit too high because if investors were risk neutral, if they knew everything, that rate should have been competed down to very close to zero on average. So the punchline here is, as an American banker in the 1940s said when he was hauled before a congressional committee to explain how they could lend so much money to Latin American countries that weren't repaying, and he basically said, it is better to have lent and lost than never to have lent at all, with apologies to Tennyson. So let me tell you about some of my own research that speaks to this question of how to make sovereign debt safe as a financing vehicle, and especially addresses this question of thinking more about what we can do to actually make risk sharing an integral part of the sovereign lending equation. So I need to take a small detour through history to give you the setting and the motivation, so bear with me. The red part here is the empire of Philip II, an empire on which the sun truly never set, or as one of the imperial crests put it, the world is not enough, which then later became the title of a cheesy James Bond movie. Everything red here is Philip II's empire from Mexico down to Peru, to the Philippines, and then Europe, Spain, Portugal, the Low Countries, vast parts of southern Italy, the Duchy of Milan, and so on. So what I did in a multi-year project with my friend and co-author Mauricio Dreligman was to actually look at the defaults of Philip II. He rules over this incredible empire. He's on the throne for more than 40 years, and he becomes the first serial defaulter in history. So he actually manages to default 4 times in those 40 years. He accumulates debt that's roughly compatible with EMU membership rules of 60% of GDP or so. It's roughly 6 times annual revenue. He issues short and long-term debt, and he's also considered one of these prime examples of lender irrationality. So the famous French historian Fernand Braudel in 1966 argued that the only way we can understand why any banker would lend to Philip II is that they're all being fooled one group after another. First it's the Germans who play the role of the Landesbanken and come in and happily lend and then are defaulted on. And then you have the Spanish, and then you have the Portuguese, and everybody eventually gets the short end of the stick. In the case of Spain, it's part of a much broader black legend where there's a story about Spanish decline that goes with it, and the defaults basically illustrate the unconstrained powers of the monarch, the lack of a regard for property rights and incentives, and basically all the deviations that come from unconstrained executive power. So what we did was to look at a few hundred fun documents like this one here. Notice the easy handwriting. So this is a 16th century loan contract, okay? And that little large squiggle in the middle is the start of where it says El Rey, the king. And this lending contract specifies an interest rate, a principal, a duration. And that's what people, until we started to get into this, that's what they used, okay? And basically all of that you see in the upper left-hand corner, that's the summary from the Chancellery of the Spanish Empire. But these contracts are up to 20 pages long. And what we did by enslaving a large part of the Spanish-speaking population of Vancouver was to code up the full contract, every one of these 860 contracts, and figure out what they said, okay? And that's going to be directly relevant for how we deal with financial shocks. So before we go there, let me just show you a little bit about the financial position that we're talking about. So Philip II has these defaults, but he actually runs primary surpluses for most of the time. You can see how the debt-to-revenue ratio over the period overall is pretty stable. So this is not debt that's out of control. So in many years he borrows, but if you actually take out debt servicing, there's actually a primary surplus with which to service the debt. That's the first thing, and that's not a sign of financial trouble. This is one of the things you can do once you've reconstructed the annual borrowing, because we have the revenue, and then you can put everything together. One requirement for thinking that something is irrational is that typically, if it's irrational, you don't do it again and again, or as Einstein said, it's not a sign of genius to do the same thing twice and expect a different outcome. So one of the things we can look at are the number of lenders who give up, who don't come back, and will not lend again. And if you actually calculate things like this, every part of the black bar here, this is total lending volume, is a lender who will come back eventually somewhere in our sample, and everything gray is someone who doesn't come back. Then for almost the entire period, there's huge stability. These guys never go away. So that's like the first smell test for how silly they have to be. Now, we know much more than Bordel. We know that the Germans don't disappear and that the Fuggers are still lending to Philip II in the 1590s. Towards the end of the period, it looks as if they go away. But the reason is that we stopped collecting data in 1600 because you have to stop somewhere. So the reason why we don't see them again is that, you know, they're just not in the sample, but they may well have lent to the son of Philip II. So, yes, there were 4 defaults, but these guys made money. One of the things we can do is actually reconstruct the profitability of lending. So to just give you some perspective, here's a bunch of returns on different assets, different bonds, in the recent period. So the best thing you could have invested in the last 20 years would have been Brazil, where the annualized return was 15% over an 8-year period. The worst thing you could have invested in was Argentina. There you would have lost an annualized 16% or so. The black bar is the average rate of return for investors who held debt issued by Philip II. So on average, our best guess is they made about 12% a year in an environment with 0 inflation. And with returns like that, you can live with the occasional haircut, which is never greater than 30%. So you may remember Argentina defaults on roughly 80% of its debt, refuses to honor its obligations. When we did the first calculations to sort of get the size of what we call the haircut on Philip II's debt, and we come up with 30–40%, my co-author, who's Argentine, said real men default on more. Now, being fine on average, of course, isn't really enough to establish the rationality of the system. And the next thing you can actually do is to look at the individual profitability of these different bankers. Because we have all these contracts, we can actually go back and look at different families and figure out just how much money they must have made. And we don't know exactly down to the last comma of how they're treated, so we calculate different scenarios depending on whether we think the worst case in the settlement applies to them or not. And you can push this any way you like. Our best guess is that they all make money, with the exception of one poor guy who lent just weeks before a default. Everybody made money for a total period of 40 years, and on average it's 12%, okay? So then what does this tell us? What it means is that the defaults that are so famous actually occur in a context in which debt is sustainable, debt burden isn't rising, there run primary surpluses. If you actually discount the value of primary surpluses back to the present, they're roughly the same as the total value of the debt. So lending was profitable, incentives seem compatible. So why then does the king actually default? Right? Everything seems fine here. What's the nature of these defaults? And what we find is that the defaults themselves are just extreme realizations of a process that's going on the entire time. What's going on the entire time is that there's lots of shocks that the king has to deal with, and he actually finds a way to share that risk with the lenders. Every one of these contracts, these 20-page things that nobody wanted to look at, are basically clauses on what happens when things don't pan out the way you expect it to. They're full of contingent clauses. So what's a typical contingent clause here? Let's take a look at one example. There's a loan contract, that's the one that you saw, between the king and Thomas Fiesco, and the king promises to repay the bulk of the money from the contract from the proceeds of the 1591 silver fleet. Spain has vast possessions in South America, especially silver mines in Potosi. Every year there's one fleet protected by numerous warships that sails across the Atlantic from Cuba to Seville. And the fleet is meant to arrive by October, and if it does, then the contract is in force and the lender gets paid. Now, if the fleet arrives later, there's going to be a 1% additional interest rate, but it's much less than the interest rate on the contract. So basically what the lenders have agreed to is to actually share some of the risk. Now, if the banker's not paid within 30 days of the fleet's arrival, then he can stop all future disbursements, and then the king will pay from some alternative tax stream but that he can designate, but later. And the banker can request that some of this debt is paid in the form of long-term bonds, meaning that it's just rolled over into a different obligation, and there's no cash call on the position of the king. So why does this work? Why can we actually write contingent contracts that have these risk-sharing characteristics between lender and borrower in the 16th century, in the age of the galleon and the post-chase, but we seem to do this with great difficulty, if at all, today? And one key reason is that there's no informational asymmetry here. Today, if you wrote a contingent bond, Argentina, for example, has some of these, but the only reason why they issued them is that they gave the investors no choice. They come out of the restructuring. If you have to deal with the Argentine Statistical Office today to tell you what the bond is worth as a result of their calculation of GDP, you might be forgiven for being slightly skeptical about how accurate that number might be. That's not a problem you're going to face in the 16th century. Why? Because the king doesn't know anything extra compared to you about silver production in Potosi. The news travels at the speed of the ships. It takes 2 years for a letter to come back, on average, from Latin America. So there's no asymmetric information here. And the shocks are truly exogenous. The ships typically don't arrive because there's bad weather. So it's only later, in case you've been brought up on a steady diet of Errol Flynn films with pirates capturing Spanish galleons, it's only later, from the start of the 17th century, that there's a real risk that the Spanish silver fleet is actually captured by pirates. The first one is Per Heim, a Dutch pirate who gets incredibly rich. So before then, it's only the occasional ship that gets caught somewhere on the high seas. So that makes it much easier to write these contracts, but I think we're excusing ourselves a little bit too easily here by thinking that we cannot really write contingent contracts today. You may not want to trust the Argentine tax office, but we do observe, for example, the price of oil on commodity markets. Has a huge effect on the financial position of many developing countries. I can think of no good reason why we shouldn't write that into some contracts. We know that there's demand for uncorrelated risks, for example, from the market for catastrophe bonds. So some reinsurance companies actually issue those, and investors like them because the shocks that hit them are uncorrelated with everything else. So if there's some lessons learned here, then I think it's that lenders, the same kind of rationality of lending behavior and profitability that I showed you before applies here as well. Everybody makes money despite defaults. Bonds actually were a form of providing insurance against adverse shocks. So you have risk sharing between the sovereign and his lenders, and this is built into the contracts, and the defaults are nothing more than a realization that you hadn't contracted upon. So the lenders always knew that they had to bear some of the cost of the king being in a bad financial position, and then if the armada sinks because you're trying to invade England, that's something you're not going to write into a bond contract. That might create some incentive problems for your soldiers. But everybody, of course, understands that you're not going to do this and that there's a risk. So in that setting, to stop paying is actually not shocking or surprising. Let me turn and continue with the topic of debt and think more about why we think that debt is such a terrible thing, public debt, and talk about a setting that's highly specific in which it doesn't seem to have caused as much hurt as we are led to believe, and then think more about whether this might apply in some other context. So Professor Gallery mentioned this. This is from recent work that I've done with Jaume Ventura, my former colleague from Barcelona. So think about this question of, is there a speed limit or an upper limit for growth, for debt until it starts to reduce growth? And Reinhardt and Rogoff like to tell us that that's about 90%, and this was all over the press 5 years ago. So if you actually look at debt levels today, you pick a couple of selected countries here, Greece always near the top of the distribution, Spain was actually kind of low for a while. And you compare it with historical rates, you get something like this, okay? So this is the UK in 1820 on top, and as you can see, even Greece looks super modest in comparison. The UK has more than 220% public debt relative to GDP in 1820. So this is not an economic basket case. This is the country that industrializes first. In the history of mankind, it's the first place to really break free from Malthusian shackles, and they do it in a context in which they borrow an enormous amount of money, and they never default on it. So how do we make sense of this? Well, there was two ways to think about it until now. One is to say, investors are so sophisticated, they anticipate that there's going to be higher taxes in the future to pay for all this stuff, and hence, through their savings decisions, they undo any adverse effect. That's what we call Ricardian equivalence. And the alternative is to say, no, it's actually painful, there's crowding out, so investment ends up lower than it otherwise would have been. So the Industrial Revolution could have been a lot faster if only they'd done it right and avoided all this public debt. So let me walk you through some evidence for an argument that says it's actually the other way around. This debt was actually helpful in accelerating growth and helping to speed up this industrial transformation at this particular point in time, and then think whether some of those features that are responsible for this result do not apply, for example, in emerging markets today. So where does all this debt come from? It comes from war. So here the solid line is the debt to GDP ratio over time from 1700 to 1850, and the dotted line are the deficits of the British Crown. And as you can see, every time they fight a war, the debt level just spikes up, and then it gradually crawls down, and then the next war hits, and there's a war about 1 year out of 3 over the period as a whole. Okay? So one thing that's important to keep in the back of our minds here is that this happens in a context in which financial systems are hopeless in transferring resources from rich guys to guys with ideas. So the transfer from the haves to the have-nots, but with entrepreneurial prospects, doesn't really work. So that's what the historians of the period tell us. Poston said the reservoirs of savings were full enough, but conduits to connect them with the wheels of industry were few and meager. And the reason is regulation. It's deliberate. The government wants to have primary access to the savings of the country in order to finance all these wars. So there are usury laws, and the usury laws actually make it near impossible to pay a competitive interest rate. If you have a limit of 5% and the government pays 4.5%, you're not going to compete for entrepreneurial projects. You're not allowed to issue new stock because of the Bubble Act, and banks are severely limited in size by the 6-partner rule, meaning you can't have more than 6 partners operating a firm together. So all of this disappears by the 1820s, but it's all in operation throughout the 18th century. So there is evidence of crowding out. So we know that the consorts are overwhelmingly held by the English nobility. We know that every time a war breaks out, they start to move their money into government bonds. So here's a letter from a bank at the time called Horse Bank that I worked on a lot with Peter Temmen, to one of their customers who's requesting a loan, and they say, at present we not advance money to anyone on any security. The uncommon supply of millions and millions granted and now raised to pay for the 7 Years' War obliges all of our profession to be prepared for the payment to customers moving their money from the bank into government stock coming on, so that instead of lending out money, we have called it in on this occasion. So that's not a financial system that's going to be particularly useful in financing new opportunities in revolutionizing sectors. They cannot actually commit to a loan for more than 6 months, and if in 1 year out of 3 you fight a war and you have to call in those loans, that's not going to work very well. We can actually find some evidence of inefficiency in the national accounts. If we actually look at the rate of return on capital, then it's rising from 10% to over 20% during this period. And the reason must be that there isn't enough capital chasing these returns. So this is a time when the yield on government bonds is 3 to 4%. If you invest in land and you enclose your land, you might earn maybe 2%, maybe 3% if you're lucky. But somebody out there is earning 10, 15, 20% year in, year out, and there is not a wave of capital chasing this and competing it away. That's a sign of inefficiency. It looks nice, but something is deeply wrong in an economy like this. So here's the evidence on the yields on government bonds and the returns to enclosure. So you can actually go out there and invest your money in agriculture and making your land holdings more productive, but that's going to have orders of magnitude lower returns. So what Jaume and I argue is that government debt in a setting like this is actually benign. Why? Because it convinces these guys here who are investing in enclosures, for example, and other forms of land improvement, to stop doing this. Okay, look at those rates of return in the early 18th century, 0%, 1%. The government pays 3%, and that's what they actually like. So they get the message immediately. For example, the Earl of Shelburne, who dies in 1751, holds 99% of his wealth not in land, but in government debt. And another landowner, Lord Monton, actually tells his future son-in-law, tells his son, what an infernal bore is landed property. No certain income can be relied upon. I hope your future wife will have consols, consolidated government bonds from the British government. And he's selling land because it's not worth to keep a security paying 2% if you can actually get one paying 5%. So if that's true, then what's going to happen is that you're actually stopping land investment. You don't need the people who build fences for your enclosure. You stop digging ditches, you stop liming and marling. But these people need to go somewhere. Where do they go? They go to the industrializing cities. They offer more labor, and that labor stays cheap. So despite the fact that you have this highly dynamic industrial sector that actually uses labor, the price of it does not move for almost 100 years. None of the productivity gains of the Industrial Revolution are shared with workers in the form of higher wages for a century. What does that mean? It's like a way to transfer extra resources to the pockets of the entrepreneurs. It's like a subsidized lending program to them that increases their profitability and makes it easier to actually reinvest those profits at these very high rates and expand faster. So what Jaume and I argue when we actually look at the overall evidence is that it results in faster growth, that there's actually an acceleration in the industrial transformation process of the British economy, that's easier to move people out of agriculture and into industry because of the issuance of government debt, which helps to drain the swamp of inefficient investment in agriculture. So what's the lesson learned here? That as long as there are pockets of inefficient investment in the economy, in a context of financial intermediation that's imperfect, where firms finance themselves from retained earnings, the government can actually help precisely because it crowds out some investment, it crowds out the bad investment, and the good guys never tempted to buy the government debt because they're making so much money on the really productive investments. So if you abstract from the setting here, the 18th century wars and everything else, there's still a lesson here because we think that in many developing countries there are pockets of dynamic inefficiency where the investment in going into the sector is much less than the return to the capital overall, where if you just stop some of the inefficient investment, things will actually get better as a result of resource allocation, and issuing government debt, even if the government does nothing with it, or in the case of Britain, probably something detrimental, may actually be benign and beneficial. Let me move on to the question of bubbles, and I think in some ways that's the most challenging and exciting question to think about if you want to challenge the view that everything is driven by irrationality. So if you actually had to draw a picture of a bubble, you could probably do worse than come up with something like this. This is the South Sea bubble in the 1720s. That's the black line. You can see other companies like the East India Company and the Bank of England also have a bit of a bubble. And bubbles I sort of like to think as the ultimate frontier of thinking about irrationality in financial markets, because we all know these stories about petfood.com valued at hundreds of millions. There are these cases where the implied value of the mother company goes negative because they have a daughter company that they own 100%, but they've IPO'd some of it. So now the stock market valuation of the subsidiary is actually higher than the mother company. Now that can never happen because the value of stocks can never go negative. So there are all these sort of things that look and sound like irrationality. And what I'm going to try to convince you of is that people always make mistakes. There may be irrational people out there, but that's not the key reason why we see bubbles of a significant size. So because it's towards the end of the lecture, I thought I'd ensure that you're all on your feet and give you a little bit of calculation along the way. So let's give you an illustration of a model, a beautiful model by Allen and Gale, published quite some time ago. So think about having to value one risky asset in a world like this. At time 0, you can buy a safe asset, and by time 1, it's going to be worth 1.5. So you get a 50% return. And there's also a risky asset that's in fixed supply, okay? So you can actually get 6 for the 1 unit that you buy now with a probability of 25%, or you get 1 with a probability of 75% in the next period. So the expected value in the next period is 2.25. So what's the price of this? What should you be willing to pay for this risky asset? Well, probably is as much as you can cope with, having listened to me for 45 minutes. The right value is 1.5. If you get a 50% return, then if you pay 1.5 now, you're going to have it at 2.25. So if you're risk neutral, you don't care that it's uncertain. That's what you should be willing to pay. So now let's add a little wrinkle. Let's add a bank. You can go to the bank and get the money that you invest. Okay? So you're going to have to pay, of course, there's an interest rate, and it's 33%. So you can actually leverage up. So if you now think about the price for the risky asset of 1.5, is that still going to work in a world in which you can borrow? On the safe asset, you get 1.5 in the next period, you pay 1.33 back, so you have a gift from heaven of 0.17 if you buy the safe asset. If you now borrow to buy the risky asset with a price of 1.5, what's the return going to be? Well, if you just do the math, it's going to be 0.67. If you pay 1.5, you own the upside, and in case you only get 1 back, you're just going to default, you walk away. Okay, so in a world like this, you own the upside, but the default is the bank's problem. And that ensures that the return here is 0.67 instead of 0.17. And that means the risky asset is a great deal at 1.5. Now, in equilibrium, that's going to drive up the price of the asset. 1.5 cannot be the price. So what's going to happen? When are you going to stop? Well, you're going to stop at a price that equalizes the return on both assets. It has to be 0.17, and that turns out to be at a price of 3. So now the risky asset, just because you actually have this bank coming in and lending you the money, you're going to end up with a price of it of 3. So that's, by definition, a bubble. Here we know what the fundamental value is. And intermediation has driven it up. Okay? Now, of course, there's a very simple trick here where it comes from. You need a stupid bank. You need a bank that knows that on average it's going to lose money. And when Alan Gale wrote the model, people didn't like the idea of needing a stupid bank to explain anything. Today, they might have had an easier time publishing the paper. So what's at the heart here of the exercise, the reason why there's mispricing is risk shifting. Somebody actually owns the upside of something, but not the downside. And the reason why I always like to teach this paper is not that I think it's terribly useful for thinking about financial market bubbles as such, but of course, the underlying thing, this fact that there's risk shifting here, speaks to a lot of incentive structures. So if I think about CEOs with stock options, and they can decide to do something that's potentially very profitable for the company, but also risky, then they can blow up the company and walk away, and they're still, not poor. But if it works, they're fabulously wealthy. So that's the same as homeowners who, for example, in the US, often can just return the keys if the investment is no longer worth it. If the house is underwater, you say, bank here, that's your problem, it's not mine. And if the housing market goes your way, you have enormous upside. Hedge fund traders have this incentive, and so on. So incentive structures here matter a great deal, and nobody has to be stupid. Everybody knows everything, and you can still get misalignment as long as you have some risk shifting of this kind built in. There's something in modern markets that makes these things worse. So I'm going to show you an example where you actually have investors who have to deal with potential overvaluation, where some people figure out that something is going wrong, and they not only do not profit from it, but when they do the right thing, meaning they attack the mispricing, they're actually worse off than the guys who make the bubble itself worse. So this is the evidence by Brunnermeier and Nagel from the tech bubble on NASDAQ in the late 1990s, early 2000s. And these are the portfolio weights of a number of large hedge funds in tech versus the rest. Okay, so the black solid line here is what the market portfolio weight would have been if you'd just been market neutral. You can see here that almost all of them are actually overweight, have a much more exposure to NASDAQ than the rest. And the interesting thing here is what happens to the guys that represent the blue line. This is the Tiger Fund run by an investment manager called Robertson. And he decides and he publicly announces that he thinks all NASDAQ stocks on average are overvalued and that people are crazy. Not an entirely silly assumption to make if you have the average PE ratio trading north of a few hundred. So as a result, they decide to go short. First, they sell everything, you hit zero, but they're actually short. And Soros, at that point, the Soros Fund, seems to share that sentiment, and they do something very similar, sell down the position to market neutral, and look at what happens to the flow of funds. This is what their investors think of their strategy. So at the point at which Soros is market neutral and the Tiger Fund is going short, they're starting to see massive outflows of 5% or so every month. The investors are saying, you don't get the internet. You're a bunch of old, hopeless guys who just don't understand the world. And then Soros listens to his investors, even despite the fact that he thinks there's overvaluation, jumps back in to a huge extent. So at some point, he has 60% of his portfolio in internet stocks, and the investors applaud. They come back. The Tiger Fund never changes its mind. The investors hate it, but they stick with their analysis. And as you see here, the blue line ends a little earlier than the red line. And it ends a little earlier because the fund is wound up. They shut the fund and hand the money back, and they do that in early 2000, about 2 months before the NASDAQ bubble pops. So what's the lesson here? In this particular context, the guys who did the right thing, who attacked the mispricing, were actually punished for it and actually went out of business. And the guys who jumped back in and made it worse lived to tell the day and are still almost infinitely wealthy. So that clearly increases the risk of bubbles, and you don't, again, even with good analysis, nobody has to be stupid here. It's just misaligned incentives that create this, this excess valuation here. So there's some, I think, nice experimental evidence that we can look at that shows exactly what works and what doesn't in terms of avoiding overvaluation. There's a paper by Ackert et al. Called Irrational Exuberance No More, and they subject the standard arbiter of all economic rationality, the undergraduate student in a lab, to 3 treatments. They want to know whether bubbles are larger for assets with lottery characteristics, meaning you have highly skewed payoffs, whether they're larger if you can borrow money, as in the Allen and Gale back of an envelope exercise I showed you, and whether not allowing short selling makes things worse. So I'm going to show you 3 pictures with price paths. The blue line here is always what the fundamental price is. So every period you can own a stock and then it pays out a dividend, and if you own it the entire time, that's its fundamental value. It just goes down over time until in period 12 it hits 0. Every one of the other lines is the price that people actually pay as they trade. And you can see here that almost all of the time everybody's too high. So this is the treatment where you can borrow and you cannot short sell, and you have a lottery-like asset, meaning it typically pays a little, but sometimes it really pays a lot, okay? Now you're going to change the treatment a little bit, and now you just have the standard asset, no short sales, and you can't borrow. So now the bubbles are just a little bit smaller. If you flip back and forth, on average, they decline by about 1/3, but you're still more likely to have things that are too high than too low, and you have some price paths that just bounce around the blue line, meaning on average they get the valuation almost perfectly right. If you now add to this short selling, where people can make money from saying, I think this is just too expensive, then you're as likely to be too high as too low. The average bubble is 0, and in some treatments it never even appears. So what this seems to suggest is that there are things that make bubbles bigger and much more likely. We have some evidence from history, we have some evidence from the lab that points in this direction, so being able to borrow and actually let somebody else worry about the downside seems to be a crucial thing that we want to worry about. That has something to say about how much margin debt we want to allow. It has something to say in housing markets about loan-to-value ratios that we think we can countenance, and certainly whether you have no recourse loans or not. It also seems to suggest, if you take this evidence on lottery assets seriously, that we shouldn't IPO firms too early when their future is completely uncertain, and you have basically firms on NASDAQ in the late 1990s that are just business plans. They never made a penny. Nobody knows whether it's ever going to work. And crucially, short sale constraints are actually a problem, and the risk that you may not be able to short sell is actually a source of financial market instability. So if you think about what happened, for example, in the market for sovereign bonds in the recent financial crisis, where you had these periodic interventions by governments saying, now you're no longer allowed to short sell, that's exactly the wrong thing if you want to avoid the mispricing first. If you think that maybe Greek government debt should not have traded at a risk premium of 20 basis points in 2006 compared to German debt, then what you want to make sure is that people can very fluidly short sell, and they don't have to worry about this opportunity going away just because you have a crisis. So what all of this put together seems to suggest is that the optimal number of financial crises is not 0. There are things that we can tweak to make the probability